Before I get to fixed income, I just want to point out the cable rate. We're almost at $1.40 for a pound right now, looking at, I think, 139.87. And we can bring it up here on the screen to see what it is live. What do you think about the strength, well, either the strength of sterling or the weakness in the dollar?
You're quite right, Matt. It could be a combination of both, couldn't it? Most people, I think, will recognize that the UK, perhaps rather through luck than judgment, seems to be bouncing a bit better than other parts of Europe. That may be one of the reasons. I also think that the tail risk of negative rates was pretty much taken off the table a week or so ago. And that's helped if you think about the possible scenarios that might be there for rates in the future. So there's a few things underpinning that sterling rally. I'm not the FX guy, but clearly there's been some upside surprise in the data and in the rate outlook, and it's all relative to the US and Europe.
You're not the FX guy, but of course it touches all the it touches everything that you deal with. I mean, you point out negative rates affects the currencies, and the possibility of that, of course, affects your world even more seriously. Is it off the table? Is it no longer something that that investors and gilts have to worry about?
Well, it's definitely not off the table forever. It's off the table for now, perhaps for this cycle. And that's a very important thing to point out. So I'm glad you've gone there. We have negative real rates at the short maturities of -200 in the US and Europe, nearly -300 in the UK. That's a function of rates being trapped close to zero, projected to be at zero because of forward guidance and QE, etc. And then when you get the rising inflation risk premia and some rising inflation expectations, then that pushes the real yield down. It's the only way it can go. The fact that the real yields are so deeply negative just tells you that markets function okay with negative rates. It's just a question of time before we get nominal rates going negative in some parts of the world. You could see it soon in the US, by the way, market rates, not official rates, market rates, because of the technicalities in the money market at the moment. There's just so much collateral around, and it's really pushing the yield down. As you've probably seen, short-dated yields in the US have been going down whilst there's been upward pressure elsewhere on the curve.
And you don't think that's going to cause a problem in the economy, in the markets?
Well, there's something interesting happening, Matt, and you can look through fixed income at things like those short yields going down so much at the moment, the possibility that you could see market yields going below zero, the cheapness of off-the-run bonds versus on-the-runs, the movements in the bonds versus swaps. There's a bunch of things that are red flags to me, and they're saying something is cooking in the system. And I know risk assets have been only going up. Everything's been going up, but there's something cooking under the surface.
Yeah, actually, our Abigail Doolittle, who watches stocks for us in the U.S., had a chart the other day showing that as we see the yield curve steepen, when it steepens more quickly, then you start to see the S&P 500 get volatile or maybe even correct. Actually, here's the chart. Hillary just brought it up, 1449. Why is that, you think, when this is the twos, tens? Why is it when the yield curve steepens, it tends to kind of freak out people and risk assets?
I guess it depends what kind of steepening it is. If it's benign, then it should be good for some sectors of the stock market. Clearly, it's good for banks who can lend at a higher rate and borrow at a lower one. In theory, at least, the steep yield curve should work for banks. But if it's fast and disruptive, then it starts to mess up investment plans, and it might start to disrupt some of the assumptions in equities and credit. You know, for example, much of the valuation in the equity market is premised on very low real rates for a very long time. Now, as you can see from the yield curve, the real rates are low at the long end and they haven't really moved. The only action is at the front end where they've been diving lower. So to me, there's a bit of a false signal being given by the bond market. Maybe the yield curve steepening is mainly a function of inflation risk premium. You should know this. It isn't actual inflation. It's the fact that the oil price went up compared to last year, and the risk premium around future inflation has zoomed up. By the way, the risk premium is a measure of uncertainty. That means it could go up or down. We just don't know. But it's not the same thing as actual inflation. So what the yield curve is telling you is it doesn't know. It's unsure. It's possible that the huge policy mix experiment might start to have some impact. It could be disruptive. That's how I read it anyway.
So is that kind of uncertainty, when you say something's cooking, right? Something's happening, something's bubbling under the surface. Do you have an idea as to what that could be, or do you have that same kind of uncertainty as well?
Well, I've written about it. I called it beneath the surface, and that's the bubbling under, the cooking thing. And it refers to what's going on with short-dated real yields. They've been going down to deeply negative levels. So U.S. short-dated real yields are minus 200 when they were plus 100 only a year and a half ago. That's quite some move. In fact, they're minus 200 in Europe as well. Does that mean it's stimulative? Is that a reason to take risk, or is that the sign of something else? You see, I think we could be seeing the latter stages of some speculative activity. And again, think about what's happening in the alternatives, in Bitcoin, and what's happened with Reddit, and the fact that everyone's looking over their shoulder, just checking what's going on here. It seems to me that something is happening. By definition, you don't know until afterwards. But there's a lot of red flags in the bond market. And I went through the list just now. Look at the bond swap spreads. Look at the on-the-run, off-the-runs. Look at the curve. Look at the long-dated real yield compared to the short-dated. Lots of stuff happening. Meanwhile, the bond market has repriced so that yields have gone back to where they were pre-pandemic. That's government bonds. Credit is still tight, and equities are flying. So you can take your pick from that. The bond market has repriced to pre-pandemic.